We're going through a growth scare now. You can see these deflationary fears showing up in like the 10-year, which is I think at 3.6% now. You can show it in defensive stocks like utilities and healthcare, which have done well. These are the kinds of things that move if you think a recession is going to happen. Now, so people, I think, it's just elevated fear, and prices have run up quite a bit. And there's also this animal spirits are in retreat, I think, due to this Trump bump, which peaked out during the assassination attempt. So you've kind of all these factors, plus AI disillusionment fears in the background as well. So it's a lot of emotion more than substance, actually. I think the economy is fine. It's just the positioning thing. The valuations being elevated where they are is just a sign of this hot money. Everything repriced so quickly.
Hey everyone, this episode is sponsored by Polkadot. Polkadot is the largest community DAO, empowering 1.3 million DOT holders to shape the future of the network through active participation. With over 500 applications backed by over $6 billion in shared security, Polkadot's adaptable technology powers a diverse ecosystem from DeFi to AI. Join the Polkadot DAO and be part of that transformation. This episode is sponsored by Mantra. The Mantra chain is the purpose-built Layer 1 blockchain designed for tokenized real-world assets and regulated digital assets, offering scalable, high-performance architecture. Positioned as the blockchain for tokenized RWAs, Mantra is onboarding traditional financial institutions into Web3. Join the ongoing OM Gen Drop campaign and be part of the future of regulated digital assets today. All right, welcome back to another Roundup edition of On the Margin, and we got a special guest this week. Tyler is out sick, and we've pulled in a great guy, Ram Ahluwalia, CEO of Lamida Wealth. Great to have you, Ram. What's going on?
Thanks for having me. Big fan of the show. Always enjoy it. I think I gave you guys a Twitter call in a month or two ago. Glad to be here. Quinn and I talk pretty regularly about markets, and it's great to do it in a public format. And Felix, it's always a pleasure. So thank you.
This saves me an hour after the show. I don't have to do my Friday debrief.
With one stone, right?
Yeah.
Yeah, I love it. I know you guys chat a lot, so I think this is going to be a ton of fun. Before we get into everything that we're talking about, I just want to open up the floor just to let you tell the listeners a bit about what you do, what you focus on, and what's your perspective on markets, Ram.
Sure. So I lead Lumida. We're a private wealth investment management firm, and we're cross-asset class investors. I grew up in the investment management business, spent 12 years at Merrill, and I said, look, this legacy wealth business needs to change and get disrupted. 60/40 is dead. And that means, investing thematically. Some themes we like include, how to invest in AI, semiconductors, how to invest in private deals, aging longevity, nuclear renaissance themes, digital asset themes, and also, investing in private deals. We launched illuminadeals.com a week ago. We did 2 deals. One was with CoreWeave, which is up about 3x unrealized, and then QXO. That's what we do. We work with exited founders and people that created wealth in digital assets, because those are generally non-consensus thinkers. They think differently, they expect more, and that's what we do. We enjoy it.
Well, guys, let's get right into this. I think, let's start with talking a bit about what's going on the macro world. The talk of the town right now is people pulling their hair apart, trying to figure out whether we go 25 bips or 50 bips on the FOMC meeting next week. Why don't we start there? How are you guys looking at this? Quinn, you want to set the stage here?
Yeah, it has definitely been interesting. We had the key point, is last Friday when we had Waller's last remarks, kind of commencing the blackout period where the Fed doesn't speak. What is it, 10 or 14 days before their FOMC, which we have next Wednesday. And then it seems like in the last few days, we've had this mad dash where the odds of a 50 basis point cut have gone from like 10 or 15% back up to closer to 50-50 where they sit right now. And really the market's reflecting that. You see commodities, gold, small caps, all pretty heavily bid in the last few days. And, just so happens that next week's FOMC falls on the Wednesday of monthly OPEX as well for a very large quarterly options expiration. So, I think you don't want to read too much into single day moves here, but obviously it seems fairly correlated, this rise in 50 basis point cut. I think the thing I find most interesting, one, I don't think 25-50 matters as much as the forward guidance does. And so you could argue that a rise in 50 basis point odds gets the Fed more comfortable to if they even don't give 50, deliver a stronger dovish tone and communicate a more accommodative easing path. You just had the ECB do another 25. So now that's 50 in total cuts, kind of maybe could read into something there. All these central bankers talk. So I think they're going to be dovish. The question is how dovish? Is it dovish enough for the markets? And is it dovish enough to bolster the economy for the next few months as this soft patch continues? I know Ram and I both think we're not headed into a recession, but I'll pass it over to Ram. But the last thing I just think is most interesting is the Fed, they're not going to admit they should have gone in June or July, even though the market is kind of communicated as such with this rise in 50 basis points. I just find it a failure in some regards that we're scrambling in the blackout period they're scrambling to leak every former Fed official to the Wall Street Journal and Nikki Leaks and, the big banks. And it just seems like we're paying billions of dollars in an annual operating budget for this Federal Reserve with thousands of PhD economists, and they can't get their communications more straightforward than scrambling 5 days before the meeting because somehow this data caught them off guard. Like, come on, right? Give one of Ram's engineers 6 months and they'll have better inflation data than what the Fed's looking at now. So it's just like, it's comical, but we play the cards we're dealt.
Well, it's a great summary. I'll say, there's never been a more challenging setup going into an FOMC meeting, and the Fed probably doesn't know what they're going to do next Wednesday either. They just saw initial claims come in yesterday, which came in even and fair and provided more evidence that we're not going to recession. And the clamor to cut rates faster has never been louder. It's deafening. It's coming from all parts. And then you've got this Japanese yen carry trade lurking in the background where, that ratio is still moving in the wrong direction. And if they cut 50 bips, does that exacerbate some of the funding cost issues around that trade? So it's difficult. I think they come in at 25 bips. That's my view on the matter. It's easy to criticize the Fed as an armchair person like we all are here. And I think most of the time we can actually, this whole QE thing, Bob Dalgo, what the hell are they doing? But in this case, it's a legitimately difficult question where honest people can disagree on it. In fact, I'm not even convinced that you actually need to cut rates. I really don't. I know that's
Why's that?
Well, there's no clear evidence that we need to cut rates. We see an economy that's robust where full-time employment is increasing, where corporate earnings exceeded expectations. Inflation's moving in the right direction. It's not, inflation it's trending in the right direction, but we're not at deflationary levels yet, and this is a boomer economy that's funded by treasury bills, right? Who's spending the money? It's boomers. How are they funded? Through these T-bills. In fact, there's a legitimate case to be made that when you start cutting rates, that source of income isn't going to flow to that. All you're really doing is shifting the beneficiary from creditors and lenders to borrower. You're shifting that mix. And I'm not sure they actually need to do that. Now, that's really kind of a moot point because that's not going to happen. We will have a rate cut. But I don't think it'll be 50 bips. So people will say, hey, what did the Fed know that we didn't know? Not that the Fed knows much that we don't know. A lot of the data is public. What are we not seeing here?
Yeah. I think that's super fair. And, this week was a CPI and PPI week, which, we've been talking a lot about how that matters way less for understanding the Fed reaction function as opposed to the labor market. But just want to go through a few slides because it did when it came out. It came in, marginally, I wouldn't say hot, but warm. So just want to go through a few slides of just talking about what we saw in the CPI print. And once again, Bank Creek Capital Advisors is who I lean on for understanding what really happened in CPI. They do some really great analysis. And this is just a really great chart just to get a bird's eye view of what are the change in weighted impacts to inflation from last month to this month. And you can see two things, and they won't be surprising to anybody who's been following markets closely this week, is that gasoline and oil prices were one of the huge drivers of lower inflation, of disinflation. And one of the big positive movers was, once again, services and owner's equivalent rent. This next slide was something that's super, super key. It kind of makes me laugh because the entire inflation story is just like a shelter and owner's equivalent rent of residences story, which is just like this hilarious survey we put out where we asked homeowners, if you're going to rent like your house or whatever, how much would you do it theoretically? So pretty much the entire thing holding up CPI above the Fed's target at 2% right now is this obfuscated survey. But the fact is that it has a huge weighting in CPI, and we saw a really meaningful bounce higher, which led to super core CPI higher, and core CPI beat the month over month at 0.3% versus the expected 0.2. So that came in. We got PPI as well that came in. Again, it's an energy and commodity story that's leading to lower, goods. There's outright goods deflation that's continuing. That's what we're seeing. But on the other side of things is that we're seeing, this continued stickiness in services and shelter. So the reason I'm bringing a lot of that up is because right before we got that amount of data, the market was leaning a lot more towards 50 bips. A couple of those hot prints that were derived from shelter led us more towards the 25 story. We've now reverted back to this 50-50 world again. But
we're going through a growth scare now. You can see these deflationary fears showing up in like the 10-year, which is I think at 3.6% now. You can show it in defensive stocks like utilities and healthcare, which have done well. These are the kinds of things that move if you think the recession is going to happen. Now, notably, yesterday, Ed Hyman threw in the towel. Ed Hyman is like a multi-decade all-star institutional investor ranked like economist. He's at Evercore now. He was in the bear camp. He thought there'd be like negative 1% GDP growth Q4. And I was like, no, I just don't see it. He was in the long and variable lags causes recession. Hasn't happened. As far as I can tell, only Bridgewater is not in the bear camp. But the point is, the economy is doing fine. It's just normal. We're at 2019 levels. Our Visa year-over-year credit card spend, one of my favorite data points, is showing 4%. Showing 4% growth. That's fine. That's what you want to see. People are worried about delinquencies. Fine. That's normalizing. It's going up. The lower end of the economy, honestly, doesn't matter. The bottom third of the economy drives a small portion of overall economic activity. So people, I think, it's just elevated fear, and prices have run up quite a bit. And there's also this animal spirits are in retreat, I think, due to this Trump bump, which peaked out during the assassination attempt. So you have kind of all these factors, plus AI disillusionment fears in the background as well. So it's a lot of emotion more than substance, actually.
I find it interesting, actually. One of a view that I don't think some people I've seen in the market, but I think last Friday, the day before the blackout, or last day of the blackout, I think the Fed was trying to communicate that they were open to 50. Both Waller and Williams mentioned things that if you put your Fed hat on that said, how do I communicate that we could do 50 without saying we're going to do 50? I'm going to say something very, very vague, but throw it out there, not just completely ignore it. And that was the September 6th day, Friday. We had kind of a market meltdown, and both of them spoke, and then Goolsby came out as well. And the market just kind of ignored it and kept selling. So I actually think they were trying to hint at it, but people didn't want to hear it. And it's this weird, the election just adds another interesting component, because I like to look at everything as incentives driven. We're all humans. These people are humans, like our institutions are humans. And, what does the FOMC, Powell, Yellen, the Treasury officials want at the end of the day? We're like peak re-election, keep my job incentive period here. There's 2 months until November. And you got to imagine if around it's a around the edges decision, they're looking at what the market was doing when they were saying 25 and there was a bit of a meltdown. There's a month and a half until the next FOMC. That's not good for the incumbent.
If they went 50, though, it may have the opposite effect of creating
people
more.
Are but the I don't buy that one, because look at commodities. It's like everybody, I think the market's like baiting the Fed here into doing something kind of ridiculous.
I agree with that point.
I don't think the market is like dumb enough to think that 50 bips is scarier, because if they go 50, they're going to give a strong dovish tone for November and December. And I think that's just like, all right, gloves are off, like get your inflation protection.
I don't think they'll do the 50, and that could disappoint markets. And I agree. Markets like to run to equilibriums before Fed meetings, either the low side or the high side. And they like to say, I dare you.
Yeah.
And so we might have a setup like that that unfolds. But I just don't see the 50. It's not supported by the data. If they did 50 now, they should have done 25 in July.
100% they should have, but they won't admit that. But the thing is if they're looking at this and saying, Yellen's and Powell probably had their Wednesday morning breakfast this week, and they said, if you go 50, Jay, things are fine. We're going to get reelected. If you go 25, things are going to melt down. There's a month and a half before. They might not melt down. The data might be fine.
Okay, I agree with the general point on this. So, like, so many tools of the American government are now being utilized to drive certain outcomes, like the Strategic Petroleum Reserve.
Yes, the QRA.
That QRA. There's a number of these policies. We could keep going, actually. I did this exercise yesterday. I got to write up about it on Twitter. It's like, oh, here's another one, like suppression of crime reporting data. Did you guys read about that one? Like the states can volunteer the crime statistics they report to the national.
No.
It's like every tool of government.
The immigration policy as a whole is globally. In Europe, it's the same thing.
So I agree with the broad thesis that you have there. On the Fed policy, look, I think even within that, they legitimately don't know. One, even if they had your view, how to best express it. Two, I think they disagree internally. It's a hard call. I mean, the data, what economic data are people looking at? They were looking at the unemployment rate, which was going up, triggered the sound roll. But then you look at the denominator and the immigration increase, which is actually expansionary and helps disinflation. So where's the bad data? I could point to housing. Housing incompletion rates aren't that great, but mortgage rates are dropping. Home builders have gone up. So markets are looking forward beyond that. Mortgage rates, I think, are below 6%, which is a real form of easing, maybe more important than actually the short-term rates, because those longer-term rates, including the 10-year, that drives CapEx decisions for corporates. That 10-year drives mortgage rates. So the markets already are easing on behalf of the Fed.
Okay, well, here, let me take the recessionista argument here, just so that we don't go too far in that one direction. And what I think about is, yes, the unemployment rate is a noisy data set right now because of that labor supply increase. But, even when you dig into it, the amount of full-time jobs are going down a lot. At the same time, they're being offset by a substantial increase in part-time jobs. And, you could make the argument that that's a really low quality, labor market that is making it look even better than it is. You can look at the recent, revisions of NFP non-farm payroll over the last couple months, where we've had that 818,000 job one, and then even just in the last two prints, there's been some downside revisions. And the concern is that once the labor market goes, it trends, and it's hard to fade that reversal. And I intuitively want to, but the fear is that it trends, and it does trend historically.
The labor market hasn't gone though. You got to see increases in unemployment. Mm-hmm. You got to see layoffs happening, and you got to see
and they're not, and you're right on that.
And here's the dynamic that I think folks are underappreciating, which is that we are now in a productivity boom that we have not seen since the late 90s. And the productivity booms are fantastic for earnings growth, and they're fantastic for income growth. But what that means is that corporates have less incentive to hire. So you're getting more slack than you ordinarily would. And we have a chart on the back end of that document. I don't know if you can find that. I can load it up. But we haven't seen productivity rates like this since the 90s. I think you're starting to see.
Is this the one you're talking about here?
There you go. Look at that. Yeah. So if you look at the 1990 range, the productivity rates were, at good levels, and we're headed back there. Generally, productivity rises when you're in a recession because of layoffs. But we haven't seen layoffs. Productivity rates going up. There's less incentive to hire. So this is a funny dynamic, right? And AI is still making its way out in the economy. In 2 years, this could be a real issue, right? Like if you're hiring AIs that are very low cost and effective and productive, what does that mean for the labor market?
Mm. So are you a believer in AI being the next great productivity boom?
Yes, there's no doubt about it. Enterprises are starting to see return on AI also. Investment banks are building one-click buttons to generate a report, right? Meta is already seeing ROI on AI spend. Maybe that makes sense. I know our firm sees that. I'm sure your firms see it as well. I mean, we build like a drudge report for investors website at lumina.com. It's all powered by AI. that ordinarily would have taken like 3 people doing a bunch of work. It doesn't need that anymore. So this is a bullish story, but it will raise issues for the labor market. It will raise issues for labor share of the pie versus the share of pie going to capital owners. Share of pie going to capital owners is going to go up. That's going to create more issues, just public issues that have to be kind of discussed. Conflict.
Hey everyone, this episode is sponsored by Polkadot. Out of the 500 protocols, one of them is called Origin Trail, and they're building a verifiable internet for AI, ensuring the provenance and verifiability of data to tackle challenges like bias and misinformation in AI systems. Used by global leaders like the British Standards Institution and the Swiss Federal Railways, Origin Trail is vital in sectors like asset tokenization, healthcare, and the metaverse. Powered by Polkadot, Origin Trail enhances the discoverability of crucial knowledge and secures information in the AI era. Power the verifiable internet with Origin Trail at origintrail.io. This episode is sponsored by Mantra. The Mantra chain, built with the Cosmos SDK, is the blockchain of choice for regulated digital assets, offering compliance-ready modules and cross-chain interoperability. With partnerships like a $500 million tokenization project with the MAG Group, in collaboration with Zanbank in the United Arab Emirates, Mantra is at the forefront of the RWA revolution. Scalable with up to 10,000 transactions per second and secured by a sovereign proof-of-stake validator set, Mantra is designed for both permissionless and regulated applications, making it easier for institutions to enter Web3. Discover more about Mantra's capabilities and how you can participate at mantrachain.io. All right, back to the show. What do you guys think about what you're seeing in global economies, especially China? That's another thing that is somewhat worrying me. We just saw, Chinese 10-year yield. China. The 10-year yield is at its lowest that it's ever been. And this was an interesting one. It's just looking at Chinese yields being surpassed by Japanese yields. So there's a lot of what I would call almost red flags coming out of China right now. I think that's a big driver of the commodity glut and pretty shit price action that we've been seeing recently. So, when you're seeing one of the largest economies go into what's looking like a pretty substantial economic crisis, I imagine that doesn't bode well for the global economy, and that it could trickle into other countries like the US. So what are you guys saying about this?
I don't have a terribly strong, super niche view on most global economies, including China, other than the weakness. These economies globally, the story for 2+ years has been U.S. economic resilience. Why has that happened? Because we printed the trillions of dollars. We are after COVID, that extended the RRP, the QRA, all these things extended our economic strength. The 10-year yield is suppressed by 100 basis points, et cetera. Our asset markets have been the home for capital inflows for, sucking in from around the world, NVIDIA, et cetera, AI. Now that is all reversing because we're taking our foot off the gas. Every economy in the world has been slowing much quicker than the US, but has not been able to do anything about it because their currencies would get walloped if they started easing while the Fed's tightening or maintaining tightening. So personally, I just think all these stories about global economic issues are late and describing the rear view, because this was problematic if the central banks couldn't respond. Now the Fed, that's why I'm so convicted in the impact of these Fed rate cuts, is about 50%. I think the Fed's just naturally inclined to be very dovish, as we've seen, and they're cutting into 3% inflation. But then the other 50% is the extreme reflexivity that the Fed easing green light gives to now China being able to do the same, reciprocate, ECB, et cetera. We now see BOJ relaxing their tightening further, restrictive stance because they can now. And to me, I just don't worry about it because now these central banks can react with stimulus. We've seen a bunch of headlines coming out of China, whether it's housing or other things. And you have India and other parts of the EM growing. So it just doesn't really keep me up at night.
I think there's China, the economy, and China, the market. I'll start with China, the economy. China, the economy is in the dumps because of property prices. We're just still declining. They haven't bottomed yet. And that's the number one indicator you should look at. When the pace of property prices decrease, when the second derivative goes up, and then the prices stop falling, the first derivative goes up, then China issues are gone. By the way, I agree with your point as well. The reason why commodities and oil are up because of China. Oil low is actually great for the U.S. economy. Actually improves margins. It's actually not a bad thing. So helps the inflation story.
Allows the Fed to ease more.
Allows for the Fed to ease more. I would say, I'll challenge you on that point, Quinn. I'd say like the Fed had so many windows to ease, and they haven't. I think the thing that's confounded people is the Fed they could have cut at the end of December. Bill Ackman said, oh, they're going to cut. Markets said, hey, we expect you to cut. You're going to pivot, right? And they didn't. And that has thrown a curveball for markets. Now, in other issues around China, around property prices, consumer psychology is posed, look at PDD, all the rest. Now, markets are different, though. And markets bottomed in the first week of February. It's been up since then. What screwed up China's market and also digital assets, and a lot of markets, by the way, is this concept I call like the hot ball of liquidity. And you can see it in China. Are we able to pull up a chart of FXI? So FXI is one of the indices for China. If you pull up the year chart, you got that bottom in early Feb. We were stalking that. I wrote that on Twitter the day it happens. This is the capitulation. If you zoom into 2024 and do year to date FXI, what you see here is that, so China had a bottom and then a massive, extraordinary rally off the bottom because all this hot money flowed into it, like tripping over themselves to get in to the market to buy the bounce. And unfortunately, bear markets end when everyone's kind of given up, throwing their hands in the air. And it's rallied too quickly, too fast. And so it's kind of compromised that market. The same thing is true for like digital assets, right? You had a massive rally in May and you had a parabola. Parabola is not supposed to happen then. You're not supposed to have all-time highs before the halving, right? In NVIDIA, you had a parabola in June. These are all signs what I call the hot ball of liquidity. But the thing is that liquidity runs away too. So it's a consequence of bad monetary policy and QE and COVID stimulus. And we're still working our way through the after effects of this. But that has scrambled markets in a way that's negative because moves happen quick. Look at like home builder stocks. Home builder stocks moved in 2 weeks. The move is done. Right? So if you're paying on lower mortgage rates, look at small caps. They rallied in 3 to 4 weeks. That move is done. You want to see a healthy bull market with like a grind up based on a rise in earnings. And it's a trader-driven, macro-driven market that reprices so quickly. And if there's a hint of bad news, like we saw in early August around a weak non-farm payrolls, then markets tank. These are the issues around China's market and also U.S. markets and growth stock markets and digital asset markets.
I think that's an interesting point to touch on, Ram. I know we chat about it in terms of like, there's a lot of analogies to the 2019 period where potentially slowing growth, but the Fed starts accommodating in an quote unquote adjustment cycle. And a big, obviously that was the middle to back half of 2019 was bad for like crypto and things. And a big difference between then and now is that equity multiples are like 20% higher, which isn't a great fact pattern. And so you're seeing like things run up to this 5,600, just using the S&P is the benchmark. Equities are pretty rich. Yes, we're getting easing, but maybe the economy is slowing and it kind of offsets like and it's completely normal too in bull markets. So to have a period, like look at NVIDIA, the whole second half of last year, the whole second half of 2020, just range bound where it ran up ahead of its earnings growth, but it doesn't mean it was overbought, overvalued, and it corrected, but then it chopped. Doesn't mean it's going to zero. Like similar to NVIDIA today, they're growing cash flows. Like maybe it didn't need to be 130, but it probably shouldn't be 80 either. And you might just not get no movement for 6 months, and that happens.
This is a good segue to like this growth to value thesis. We have a chart showing this growth value ratio over time. We can pull that up here. But you see all these things come together there. Multiples, the hot ball of liquidity, animal spirits, all in this one chart. So like ordinarily, like the average annual return on the U.S. equity markets between 8 to 9%. Often any given year, you don't get anything close to that. You get big numbers like high teens, 20s, or like -2 or 5. okay, and the occasional bear market. So if you look at this chart, what you see are these growth to value spikes. They happen at the end of the dot-com era, where you had a big technology cycle. They also happened in around 2006, 2007, where you had a big CapEx cycle around housing. They didn't end well. And you also had it leading up into 2021. You can see that chart where the blue line just spikes higher. And then, of course, that led to the 22 bear market, which was not accompanied by a recession. Okay. So here we are in 2024, we had a similar growth to value spike. This is a dynamic I've been writing about since March. Yesterday, I should note, BlackRock came out and said they are now overweighting value. BlackRock, managed a lot of money. That's going to have an impact there. So, but if you look at that ratio, that increase from 1.6 to 2.1, what is that increase? It's like a 50% return in growth stocks, a massive return. And, we saw that in semiconductors. You see that in big tech. You see that in Meta going from $80 to where it is now, right? So markets pulled forward a substantial amount of the increase in expected earnings. Again, it's a hot ball liquidity phenomena. People got jazzed up also around GPT. When GPT was rolled out, growth stocks started ramping. So now I think value will outperform. But this has also screwed up market. NVIDIA and AI messed up markets because NVIDIA, Quinn's point, they are generating earnings per share in lockstep with their share price increase. Arguably, it's cheap. Shopify's got like a 54 PE ratio versus NVIDIA. Yeah. I'd rather own NVIDIA. I could say that same story for FICO, for Costco, for Kava, and many, many other stocks. So NVIDIA has dragged up other growth stocks as it's gone up in price, but the other growth stocks haven't delivered earnings like NVIDIA has. Right?
Yeah.
So that these correlations are scrambling how people perceive and invest and trade around markets.
Yeah. I think that's such a great point. And like when I look at this chart, the first, and I came into investing through like the classic value style thing. So, when you're saying that value is going to perform, I'm like, oh, that's great because it hasn't for the last decade. But it feels to me like when I look at this chart, what I see is this transition in markets where we've gone from this like efficient capital allocation machine to like this debt refinancing, highly liquidity driven machine where, like we talk about, all these political institutions are used as basically like vol controllers and liquidity controllers. So when you say that we're going to return to a regime of value, to me, that's saying to me, we're not going to go back to a world of QE. We're not going to go back to a world of ZERP. We're going to have an actual discount rate to value things like cash flows against, and there's going to be fundamentals that are driving markets again.
That happens. Months back, growth stocks go up and to the right, and digital assets go up and to the right, and all that happens. I would say one other interesting features, like in the 2010s, it was big tech driven, but value stocks also beat other growth stocks, which you control for Max 7. It's another fact that's underappreciated. So, you can see like Costco. Costco is now a growth stock, right? It's got a PE, I don't know, in the 40s. It was actually a value stock back in the day. So, value does work over time. It's working now. And I have another chart if you want to pull it up or not, it's up to you. But value has been beating growth over the last year. Most recent week, that's kind of anticipated because growth just sold off. A lot of stocks at their moving average and they're just kind of bouncing out. So this is a new regime. And I think this chart has a lot of consequences because when you have a growth to value rotation, you generally see multiple compression for the broader indices, by the way. Okay. So now you're trying to swim upstream at the index level. Earnings growth has to overpower multiple compression. That's kind of hard. Now, Amazon's managed to pull that off. Amazon's multiple is actually compressed from 80, where it was in 2022, to where it is now in the 30s in the 4 PE. But the earnings growth has helped it go do that. But, these growth to value rotations, they've happened in periods in time where it's not pleasant to own risk assets or high beta stocks. So
2022.
What's working? What's working in the last 2 months? Defensive, staples, utilities, financials. Those are value stocks.
How do you square that against the passive thesis of like market cap weighted stocks getting more flows?
I think the passive breaking markets is wrong and flawed. And that because this is a factor driven market. And the factors that have worked this year are momentum, earnings growth, quality. And then those factors stopped working in early August. And now the value factor is working. This is actually a factor market. it's a factor trading market. Anyone that is active in markets every day, you see these correlations. You're like, oh, everything in this bucket went up or everything in this bucket went down, right? Like highly shorted stocks rise and fall together as a category.
For those that we don't talk lots about like factor models, but for those that's new to, could you just explain the idea of factor models and how you basically attribute returns to them?
I'll try to be brief here. You double click the level of depth you want to go, but the most important factor is called the market factor. If you in school they teach you like the Kaplan model, you learn what beta is, and beta is the market factor, and every stock's got a sensitivity to the market called beta. That's a single factor model, but you can build multi-factor models, and those other factors include things like value, the market cap of the stock, momentum. In fact, someone won a Nobel Prize for identifying and researching these factors. Now we have like 15, 18, 24
endless factors.
Right. And they're essentially you regress stock price returns, like in a panel regression, against a portfolio that is a market neutral basket that's say long high momentum stocks and short negative momentum stocks, where momentum is defined as stocks that did best in the last 12 months. That's momentum factor, right? So you can find what their exposure is, and you can measure the returns on these market neutral baskets called factors or factor portfolios. So this is a factor-driven market. People are trading factors. That's what's happening here. Semiconductors are part of the growth factor. Semiconductors as an industry are their own factor as well. Within technology, what's worked is semiconductors. What hasn't worked is cloud.
On that one, so obviously like utilities, staples, defensives are value trades versus growth trades. So we believe, and I'm with you there, I think the AI Mag 7 large cap tech was the safety trade. You had treasuries, the worst performing asset in the last 4 years, and a slowing economy that started in late Q1. And we're just obviously talking about it now, but assets were trading like a slowing economy starting in April when bond yields ticked and came all the way down almost 100 basis points. So I actually view that as the safety trade. Okay, slowing growth. There's one thing that's still growing, AI. And now you have the Fed cutting. We're getting into what we believe happened, is the re-inflecting economy. Growth's coming, economic Main Street growth is coming back, and that should be good for cyclicals, home builders, et cetera. But how do you balance the rotation of value trade with the, because like you said, a lot of times that's a trade that works when risk assets broadly aren't doing well in a recessionary potential environment. Because I'm looking at utilities and I'm thinking like, I'm short bonds here. I think these levels are pretty attractive if you want to short TLT. Utilities is like an equity beta version of that. Staples, there's other stuff going on with staples. It might be fine if the consumer's weakening. But to me, those are the big components of value. And I want to be geared towards value, but I don't know. Things have kind of ran, like you said. These we're getting these moves. Utilities are up like 20% in a month. It's amazing. I kind of want to short them as my funding.
I wouldn't short the utilities, no. So excellent points you brought up, by the way. Number one, on Mag 7, look, these are the best businesses in the world, and it was a great trade, and it was a defense flight to quality trade. But it was more than just a trade. It was an investment because they also grew earnings. So the fundamental thesis was there. And, coming out of 2022 bear market, they were also cheap. Like Meta was 4 PE was like 10 times earnings. So the fundamentals were there, earnings growth was there, and it was rational to hide in those names, and they worked. So where we are today, if you look at the year-to-date performance of returns by category, infotech is growing because of earnings growth, not multiple compression anymore. It grew last year primarily because like multiple expansion and also earnings growth. So you're closer to fair value there, but earnings growth should still happen. The question is, do you get any multiple compression as rates, long-term rates, if they go higher for longer, right? On utilities is a legitimate earnings growth theme because utilities is going to power data centers, out along VST, for example. But these utilities, by the way, as a category, they've outperformed the S&P over like decades. Utilities have beaten the S&P on average over decades, right? So they're a good category to own. They have stable earnings, stable cash flow. It's hard to enter the market. They have barriers to entry, and the demand for energy from these utilities has gone up quite a bit. So like my approach is this: like S&P is roughly 50-50 growth and value. I'm tilted 60% value. Maybe I should be 65%. That's the thing I wonder about at night. Like, do I
65 or 60?
I wake up at night like, do I own enough value here? Because in a similar setup to like Mag 7, right? Like if you can, like, insurance is the second best performing industry group year to date. Not many people talk about that or know that. It's the second best performing industry group to date. Why? Well, year-over-year CPI prints show that insurance costs are going up, auto insurance, right? Well, guess what? Property casualty is going up too. And people living longer, and life insurance costs are going up. And regulators letting them pass that on to the consumer. And they're indexed to the yield curve from a slope of positively steepening yield curve. So there's, I think and you got to look at it both from the trade, but also the investment and the fundamentals. And can you line them all up? And the hard part about this market is that, things are pricey. Like the Mag 7 names are, I still like NVIDIA. I love Google here. NVIDIA Meta and Google met by 3 picks year to date. Meta's kind of pricey. I think it's a wonderful business though. And they need a 30% revenue growth. Amazing. So positioning is the hardest part of this market.
Yeah, and the utilities, that makes sense. So you're a secular beneficiary of this huge trend. Given these quick moves, we obviously are coming out of this like recession scare, growth scare. What areas or pockets of the market do you see where people are hiding out that, from a first principles basis going forward, might not? By the way, on your defensive, the other reason I like that is because the macro lines up, and I'm not taking a lot of bets on the election with the defensives. Like if Trump wins, we're going to get infrastructure spending. If Kamala wins, the macro just prevails. Versus like there's headline election risk with a lot of other sectors right now, whether it's Trump saying something about Taiwan and AI getting hit, or you if you can kind of line those two edges up where the macro works and irrespective of the election outcome, you benefit. I like those. But what pockets of the market would you say, maybe people are hiding out or just the outlook doesn't match where valuations are?
It's going to be where the relative strength is. People are hiding out NVIDIA now, right? NVIDIA is outperforming other Mag 7 names. That's one. I would say, obviously, like gold, people hiding out in gold, that's gone 2 years beating the S&P. I don't like to be late to the party on things like that. I'm not a big gold bug either. Rather own things that have free cash flow, buybacks, earnings. I think that's the other category too. I think it's a really good thesis also is if you believe there's a growth to value rotation underway, and you believe we're in a new rate regime, then just the way discount rate math works, value stocks should do better. And value stocks with free cash flow and buybacks, net of share-based compensation, is a good move to make. Small caps that have positive qualities, not IWM, not the Russells, not a Garmin, not biotech. Biotech is tricky. Back to the hot ball liquidity. Biotech stocks and small caps generally rally after the first rate cut. They already rallied. You look at financials, they rallied. So the market has pulled forward and arguably priced in the first rate cut. This is a different game. It's a different market setup because of that hot ball liquidity. Now, tactically, I'm actually cautious going through all of October. We expected a little bit of a growth bounce. I bought NVIDIA Thursday last week. I wrote about that. This 105 price was kind of silly when this antitrust issues went away. Yeah. But, it's like, I'm tactically underweight risk out. I'm still net long because my mandate is to be net long, but I'm tactically underweight. I think at year end, we finished pretty strong because the economy is strong. Value stocks will do well. I believe the semiconductor earnings story is a real story. So I think they will do well, but you got to pick within that. Like if NVIDIA and AMD have the same 4 PE, does that make any sense? It does not, right? And AMD's got a 30% margin versus NVIDIA, it's like 75%. So it's not just sector positioning. Like the game, the technical difficulty, if you want to use an Olympics metaphor, is like 9, right? You not only have to get the position, the category level right, you got to get the names in the category right. Like if you bet on Intel, you're in the dumps.
What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Teffiaro will also be there. Not only that, but we're also going to be doing a live recording of the weekly Roundup on the Margin Guys Emporium edition. So you can come meet myself and Tyler and Quinn, and even Mike will be there. If you're interested, we have a discount code, Margin10. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show.
I have a proposition. Sorry, Felix, I'm hogging.
I love it.
Okay, so all I read end of August was how strong the first 2 weeks of September were seasonally, and then the last
seasonality.
2 weeks,
yeah.
And then so in August it was like the Goldman reports were like the first 2 weeks, best 2 weeks of the year, and then the last 2 weeks of September, everything goes to shit. Get out, around September OPEX, and then the first week, because we had the big dump when everyone came back, it said September seasonality. Oh my God, it's the worst time in the markets. You should have been out. You should have seen it coming. And I tweeted something like, how about we just get everybody off sides where we dip, the seasonality bears get super overzealous. Now we're back again. I mean, it's kind of played out. We're back to all-time highs. And then the next kind of narrative is like, oh, I can't extend risk because of the election. I can't, business managers can't make decisions. The economy's on hold. The market's on hold because of elections. But then I look and I'm kind of like, okay, so I'm looking at baskets of Trump stocks like Geo, the private prisons, Fannie and Freddie, these stocks, and you look at those outright and relative to the benchmarks. So it might be small caps or something, and they're at year-to-date lows. So I'm looking at traditional Trump trade assets as really nothing, no irrational exuberance. And so
that's good.
Yeah, it's a good thing because obviously he's the pro markets candidate, and there would be a quote unquote Trump bump in particular industries, but the market overall, if he wins, and it's not priced in, apparently, maybe it is, but it doesn't look like it is. So what's the biggest
got unwound for sure
scare factor going into October?
I think there are a few additional overlays. One is like energy stocks, maybe they've been, but they quite haven't though, right? And they certainly were doing really well during the Trump bump phenomenon. When Harris concluded that debate, all Dow 30 stocks were down before like this midday intraday reversal, but energy stocks stayed down. Now, I do think they actually might well be bottoming here. I do think that's quite possible, just given where oil is and all the rest. So you raise a good point. You're saying, hey, look, isn't the bad news priced in? Isn't the Trump deflation priced in? Like, what do I have to worry about? Well, I would say there are two things. One is markets have pulled forward and discounted a lot of the benefit of the Fed cutting. That's one. So I'm looking at that. Like, okay, these things are already bid up. What am I going to buy here? Number two is like tactically on the ground when we're looking for assets to buy, it's just so hard to find something. So I was actually in September 1st, said September to remember. And the way that came about is over the weekend, we're looking for like, what should we buy? Not a darn thing. They're all overbought. And so that's the concern, right? Sentiment needs to wash out a bit more also. I think sentiment is still a bit elevated. So that's another way of saying that people are over positioned on risk assets. I look at, marginal liquidity markets like digital assets, which are still trading down, and uranium's trading down, notwithstanding the recent news from Russia that bumped uranium recently. But like animal spirits is on a downtrend.
Yeah, I was going to say that the fact that you're mentioning that a lot of this market is priced in rate cuts, I think if you told that to people that trade digital assets and crypto, they'd say, there's no way. I'm so down bad right now. What the hell is this guy talking about?
Right.
So, what's your perspective there?
They're like the first musical note to get played, so to speak, right? So
we brought forward like 12 months of demand with the ETF. That's kind of what happened.
That's another factor too. And then the other factor on digital assets is NVIDIA. If you look at a MEV-RV chart, I posted it in my document as well, where these nice, pretty like harmonic cycles that look like the inviolable laws of physics being presented before us. And we just buy and ride that and then sell it. Then you make money, right? And that's kind of the story. And I don't think that story works here because NVIDIA and GPT has changed the dynamic. I wrote something called the NVIDIA correction hypothesis in late May, and NVIDIA has taken the shine off digital assets. People are investing in digital assets. NVIDIA. I see it myself. Like the question is this: what's going to have a higher year-end performance? NVIDIA, or driven by earnings growth, or digital assets, or you've got political uncertainty, where if Trump's not the victor, it's bad for digital assets, bad for stablecoin, bad for Circle IPO, bad for bank distribution of digital assets, bad for NFT, bad for revising crowdfunding laws, right? It's just bad.
Totally.
Like, where's the product market fit story going to come from if it's illegal? Bad for DeFi. DeFi is a wonderful thing. It makes financial markets better. But so those dynamics have changed the game. And, the hot money of animal spirits, and crypto is all about animal spirits. You want to buy when animal spirits are bombed out, and you want to sell when it's peaked out. It peaked when Trump gave a speech at the convention. And, animal spirits are leaking as a category overall. They're just leaking. You can see it in like uranium, other hot money categories. Look at SaaS stocks. They're leaking there as well. WCLD, like SoFi stocks, right? There are a handful of areas that are still doing well. Look at like Tesla. It's gone nowhere in 3 years. So crypto needs these animal spirits, and that momentum is getting attached to NVIDIA and AI.
Well said. So do you think crypto is just dead money until the election?
I think you kind of got to reassess. Look, there's obviously good seasonality in October. We do have a mini revival in animal spirits, but I think it'll be faded. I don't think it's like enduring. So I agree. I think the political dynamics matter a lot. It's just a hard asset to, kind of bet on right now versus other assets.
I think that for me, and I'm like, my macro process is a hammer, so everything I see is nail through the macro lens. The most comfort I get in crypto, and I've been kind of vocal lately about how I think the best risk reward going into the election, if you want to bet on crypto, is Bitcoin. I just don't see any reason to go out, because you have the macro traditional people. If they want to put on a Trump trade, it's kind of consensus that Bitcoin is the highest torque Trump trade, and then the reflexivity of having those ETF flows and no other asset has it. But on that point of digital assets, or Bitcoin in particular, when you have gold going up into this very, very strong trend, and the positioning length in gold is not you don't want that in your asset. It's like we're at record levels of long, the commitment of traders reports and et cetera. But it's been like that for a long time. We have central banks, new central bank or country announcement buying every week. And you have the Fed and global central banks. I like how, like in the last week, the Fed said inflation's not a concern anymore. We beat it. And then the ECB said, we expect inflation to rise. So nothing kind of makes sense anymore on that front. Yeah. It's probably bottomed. So I think that's the most supportive thing for me from a Bitcoin digital assets perspective is it to some extent, not one-to-one, but drags Bitcoin's value or floor value, let's say, up when gold is leaking higher.
I think the psychology around crypto is also broken. Psychology is foundation for all markets, and especially animal spirits, right? So we had the parabolas in May. A lot of people are offsides. They did not invest in digital assets in 2023 off the bottom. They saw the rally. They scrambled to get in around November, December. And then January, February, you had the Bitcoin ETF, you had a top and a dump. And since then, they've just been offsides and chasing. NFTs have been leaking. NFTs are the marginal liquidity market within crypto. So it's just a difficult, it goes back to that hot ball of money. It's kind of messed up so many market dynamics that you could ordinarily rely on. These moves happen too quickly. Remember, the average annual return on the S&P is at 8%. So we had a substantial, like 20 to 40% return, pick your index, in a couple of months. So then what do you do with that? That's happened. So NVIDIA goes up like 140, and it is a good fundamental story. But now everyone's in, and it's got to correct down to like 105. So that's the issue with these markets. Like, there's so much liquidity in the market that it is messing up traditional ways of analyzing these markets. One way you can look at it is that you can say, hey, did the liquidity monster show up in this market or not? And China has showed up. You can see it on the charts. That parabola we saw. It showed up in crypto. It showed up in NVIDIA. And when that happens, you need to let it rest for a few months and then get back in, right? NVIDIA peaked June 16th. We got back in last week. What's that, a couple of months? China's still stabilizing now, but every market's different. Gold never had that problem, by the way. Notice that. It's got a nice steady slope. it is going to get crowded, of course. Maybe it already is. Central banks still buying fundamentally. We see that. But it wasn't like a traders ram the price higher and then they get off sides, and then that dynamic never played out.
Yeah, it's a super clean chart. One, I want to throw this framework at you guys that I've been thinking about is that when we look at Bitcoin's price action over the last 4 years or so, like the previous cycle, a lot of it was driven from this uncollateralized lending market that grew up, Silver Bank and all of those dynamics that really allowed uncollateralized lending to occur in the crypto market. When FTX imploded, that disappeared. And then we were just, nothing, it was dead money. We were just chopping around 20K. And then what happened is that we got the ETF narrative to what feels like replace the uncollateralized lending component that kept us from going higher. So when I look at price now, we're around 60K, but we don't have that, there's no uncollateralized lending and credit whatsoever anymore right now. But what we replaced it with is ETF flows and that component. So under that framework, people get really upset about, why are we not at 100,000 when we're getting like TradFi buying ETFs? And I think it's because it's replaced that in terms of this like equilibrium price. So what happens from here?
Insiders are selling. Gotta be. Hot market demand from the ETF.
Yeah.
They, we did the same. I did the ETH trade. Quinn, you did these trades too, the GBDC trade. And on May, I was like, all right, we are now exiting our ETH position. Here we go. It was great.
Mm-hmm.
We weren't calling it top, by the way. That's not it.
Yeah, it's just the trade ran through. That was it.
Right. We saw the parabola. We're like, we're supposed to sell here. And unfortunately, there wasn't enough demand to carry it beyond. That's the issue. It's all about psychology again. It's like if the vectors aren't rolling in the same direction and the psychology is broken, then markets, and then it can't go on. Like Kava will break when Kava breaks. It sounds tautological. It's not. 304 PE. It'll break one day. It'll have a nice right shoulder, and then the whole thing is done.
I love that. I love the keep things in perspective. The S&P annual return 8%. And I think back in the last couple of months, I launched a fund in May, and so it's like, of course, you launch it in the worst.
Like in 2 days, right? You're like, later.
No, but I'm just like, but for my track record before the fund from July to through April, I think 10 months was like a 300 some plus, and I was just like, yeah, it makes sense we would cool off for 6 to 12 months after that.
Yeah. I mean, you look at funding rates at that time, and they're like 100% annualized. It's just like, how do we go any higher from here?
Which is almost, it's like it almost perverts the trend, like extends the required pain to reset the trend because the price, maybe Bitcoin went 25 to 75, let's just say, and the price of Bitcoin did a 3x, but the bulk of the flows from the new buyers came in the tail, probably third of that movement, and those are the people you need to extend the rally, and they're all burnt. And it's like, all right, what we need, we need a reigniting economy or something to kind of get the propensity to purchase this asset again.
There's several things that came together in that analysis, which I think was right on. One, it was like, hey, price moved a lot, valuations went up. That's one. Two, people got burned. And, that's how these markets end. I had an interesting post last night around like when IPO markets end. It's when people buy something that's hot money and it doesn't go up, and they're like, oh, like I'm just going to pull back. And that's what's happened a lot of all these parabolas. That's what's happened. That's what happens in the parabola.
I'm going to bet though there's not the most, excited view here about the digital assets. I'm always excited. It's what I focus on. But, Ram, you're a relative value guy. You're playing everywhere. But I'm going to say within 2 months, you're starting to look at the digital asset space.
I think that's possible. I think it's really quite possible. I just got to reassess. Like what I don't do is try to forecast at the hand that the Mr. Market will deliver to me. I play the hand right in front of me as I see it, because those are known observables. Like looking around, I have general ideas about the future, but I'm going to revise them 8 ways between now and like Sunday morning based on some new data point or something. I think the IPO market comes back. That's really bullish for growth stocks, actually.
And part of that is the bank lending market too, with the front end of the yield curve down, profitability higher because I
agree.
It's steeper. That's lending.
Earnings growth is back for value stocks, so that supports value stocks, right? So I think the economy is fine. It's just the positioning thing. The valuations being elevated where they are is just a sign of this hot money. Everything repriced so quickly, right? Is there a sector that hasn't? There's the ones that haven't are where you should be exploring. Back to the
it's energy, really, but I mean it's facing its own idiosyncratic headwinds. Digital assets has been in the dumps for 6 to 7 months. That's what makes it more maybe relatively attractive than things like small caps that have ripped.
Digital assets had the kind of pump in May, right? Semis and NVIDIA had the pump in June. I think NVIDIA is still legitimate and real though, but other semis are lagging substantially. QQQ, even QQQ is lagging the S&P, right? So financials have been on a tear. They pulled back recently. We don't know if it's a blip or the continuation, et cetera. But in value, you don't have those dynamics there. So I think that's where you want to play. But it's a good risk indicator, right? If you see the parabola, it's hard to get two parabolas when like a 6-month window.
I also must say that we're talking about the hot ball of money and these characteristics of the market arising because of liquidity. And I think it's funny we're recording this 3 or 4 or 5 days on the eve of the Fed entering not just an adjustment rate cut, but likely another full-on rate cutting cycle. And so you can imagine why.
I don't think it's a full rate cut cycle, by the way. I think they're just.
What's your over
is that to 3% or what's your definition?
I think
it's like 4 cuts is what I kind of think. But to me, that's enough to really juice things.
I agree with that too. I think base case is 3 25 bip cuts in the next 3 meetings. That's one. Then they pause and reassess. If we have a full on rate cutting cycle, we have a bear market.
Yeah.
Right.
Agreed.
In that, this is something that a lot of people love looking at liquidity indicators. I'm not a huge fan of liquidity indicators because they're not binding constraints on price action. They lag. Like, I'll give you an example. In 2008, the Fed threw every liquidity facility under the sun. They're cranking out new liquidity facilities like every month, every other week. TALF, they did the TARP program, asset-backed programs. It didn't matter. Markets didn't care about any of that. It's psychology is a fundamental thing, right? It's when Bank Term Funding Program rolled out, it's how people responded to the interpretation of that actually.
Right. As stopping the crisis basically in its tracks.
Which is legitimate because there's a causal reasoning there, right? But that happened. The other part was when the Fed put us back now, right? When the Fed put us back, came out like a few months ago, I guess in December, really, right? Powell said our next move, not the immediate next, but our next move will be in the direction of down. Fed puts back, cool, markets ramp up. It wasn't the actual injection of liquidity per se.
No, and mechanically that allows people to, that lowers bond vol, which allows them to buy, even though just by knowing there won't be any more hikes. It doesn't matter how many cuts they'll get, but just from that admission, volatility comes down. You can see that in the MOVE index.
I agree. This is a late cycle market, late cycle equity market, not late cycle economic market. And I don't know that we've seen that. Have we seen patterns like this?
1970s, the last inflationary regime.
By the way, 70s is really interesting analog too, because if we're seeing the 10-year drop, which we are, and mortgage rates drop, and globally central banks are cutting, and you see a resumption in like housing demand, then your shelter costs go up, right? That's the fear.
It ends with inflation round 2, and this time it's worse because the consumer is starting from a weaker place, I think.
Well, I think that's the risk factor. That's the left tail risk factor, right? And that's why the Fed can't do like a full-blown rate cut. It's like shelter is still, it's grinding down lower. Like the real-time market-based indicators of rent show that inflation speed. But if you do lower those rates and shelter costs start going up, but you've already ignited other parts of the economy now, right? What are you going to do? What do? You raise rates.
I mean, goods deflation is ridiculously it needs to mean revert here. It's just, I don't know how much lower we can
And
go.
we're at 3 and the index is at 3 and it's like in the gutter.
With a 3 standard deviation move lower in goods deflation on a month-over-month basis.
This is a great market for folks like Quinn and I, actually, because you can see these imbalances and these dynamics and adjust, but it's not an ordinary market.
It's not like a buy and hold and set and forget.
right? Because the buy and hold gets re-rated in 3 weeks.
Mm-hmm.
And what are you supposed to do then, right? You can hang out and...
I think a good summary of like that point you just made, Ram, about, it's not just what the Fed's doing, it's the psychology and the knock-on effects into the market and the behaviors it stimulates, because there's been a big push over the last couple months, I would say, with very little return on that narrative of, Fed rate cuts are coming. It's a reason to get long. It's a reason to be aggressive, on the bid side. But when you look at what actually is going to happen, and it's always price narrative, right? Price moves, and then everyone tries to assign why that happened. Like today, the market's soaring, and it's like, oh, it's got to be because the 50 bips rate cuts just more priced in.
Totally.
So, but then you think to next Wednesday and whatever the Fed does, they're going to do. But one thing we're probably pretty sure they're not going to do is admit a big mistake in not previously cutting. They're not going to, tear the Band-Aid off, remove the data dependency. Like, they're not going to just go full bore. We're cutting into perpetuity, because I do think the December 2023 meeting, I do think they should have cut earlier this year, but that December 23 meeting scarred them because they saw what that did.
They were right. They just got spooked. But
look, S&P was at 5,600. Like a massive double-digit return in S&P and QQQ year to date just a couple of weeks ago. We're only like 2/3 of the year in. Now imagine if they had cut earlier this year, we'd be at 6,000, right?
Oh yeah,
it'd be lights out. You'd have the IPO market would be open now. Strike would be going public now, and then next year you'd have a significant correction.
Yeah.
So this is and by the way, like I'm an investor. You're more tactical, Quinn, but I love the dynamics. We can look around corners and test ideas, and we're trying to position for the long term because I don't want to pay short-term capital gains taxes, right? So it's a very interesting market. I don't know that people kind of get the dynamics around this market. I think everyone's a trader now. 0 DT options. It's all over the place. It used to be margin debt. Margin debt was a metric I would look at, and when it peaked, it's time to sell. You can look at cash levels in the Bank of America Flow Show report, which we look at regularly. When it was at in middle of July, it was too low, right? So these are all contra indicator signals. When no one's a trader, that's when you want to buy. Everyone's a trader now.
Yeah, that's such a good.
Everyone's a COVID expert, trader expert, every expert, yen trade expert, whatever. So,
well, I mean, when we all have our brokerages on our phones, it just changes the time horizon. It's hard. Well, look, guys, that was a really great conversation. Ram, it was a ton of fun to have you on. We're gonna have to get you back on here again. We'll wrap it up there. Yeah, but thanks, guys.
Cool.
That was awesome.
Have a good weekend, everybody. Thanks, Ram.
You will.
There's over 500 protocols building on Polkadot, and one of them is called Polymech. Polymech is a decentralized, community-driven funding protocol on Polkadot, enabling regulatory compliant and transparent fundraising of Web3. Polymech ensures compliance with a novel KYC AML process, facilitating a trustless and automated funding process from fundraising to token distribution. By removing intermediaries, Polymech offers accessible, inclusive, and transparent funding opportunities for all participants. Powered by Polkadot, Polymech is redefining fundraising in the crypto space. Explore how to become a Polkadot VC at polymech.org.